Hello and welcome. Today we are looking at Starbucks. We're going to take a quick look at the historical price of Starbucks. We're going to run it through our full system stock valuation method to find our intrinsic value, our acceptable buy price with our margin of safety, and we're also going to take a quick look at the dividend safety and run through some metrics. So thank you for joining, and let's jump straight in. So as we can see, over the 10-year period, Starbucks has grown 260%, which is very nice to see as a shareholder. The current yield is sitting just below 2%, and the forward PE is around 32, which is above the S&P PE of around 22. Now, just very quickly before we continue, the year to date, Starbucks is up 7.3%, which is good if you are a shareholder and have been holding for quite some time. And now we're going to take a look at that dividend safety. So currently the score is 67, which is safe. The market cap is around 124 billion. And let's take a look at the other figures. So dividend growth, what I love to see is double-digit dividend growth consecutively. And as we can see here, they have been growing their dividends for the last 12 years. The latest increase of 8.2% in September that's just gone. And if we look more importantly at the dividend CAGR over the last 10 years, 19%, double-digit growth over the last 10 years. That is very strong and something I love to see as a shareholder. Now, if we take a look at the comparison to the 5-year average, dividend yield theory states that if the dividend yield of a company is sitting above the 5-year average, then it is potentially undervalued. As we can see here, the 5-year average of the yield is 2% for Starbucks, and it's currently sitting at 1.96%. So, based on dividend yield theory, you could say that Starbucks is reasonably valued. Taking a look at the forward PE, it's around 29.9 with the 5-year average of 29. Again, fairly in line with their 5-year average. The sector PE comparison, Starbucks is around 29.9 with the consumer discretionary at 13.3. We're going to take a look at this in more detail when we do our multiples valuation. And Starbucks is currently trading along its 52-week high of $109.99. I typically like to look at stocks trading towards their 52-week low. However, just looking at this in isolation does not mean that the stock is overvalued or undervalued if it's sitting at the other end. So let's move on. Earnings payout ratio and free cash flow payout ratio. If you've seen my other videos, you know I love to look at the free cash flow payout ratio for the majority of companies. However, just for the investors who like to see the earnings payout ratio, we can see that for the last 10 years, Starbucks has been around that 60%. The last 12 months was around 68%, with forward looking at 59%. I like to see around 60% and below, just because then it means there's room to grow that dividend, just as Starbucks have been doing over the last 10 years, double-digit dividend growth. If we look at the free cash flow payout ratio, the last few years, 2021, 48%, 2022, 90%, and forward-looking, 73%. Again, quite mixed and quite a range, something that I'd keep an eye on and probably understand a bit more. However, it's not looking too bad currently. If we look at the sales growth, one thing I love to see with sales growth is if companies can increase their sales in double digits. As we can see, this is what Starbucks has done for the large part. In 2020, when we had COVID, their sales dropped 11%. However, the following years, there was that continued double-digit sales growth, which is lovely to see. Now, the total sales over the last 10 years, 14.9 billion in 2013. And 2022, 32.3. So I like to see that. That's essentially double the sales over the last 10 years. So that's very positive. And if Starbucks can continue this trend, again, that is a very positive sign for dividend growth investors. Shares outstanding, as you know, we like to see this declining, as this means that the companies return excess cash to the shareholders. As we can see over the last 10 years, there has been a nice drop, in my opinion, from 1.52 billion to 1.15 billion. So again, this is very positive and shows that Starbucks does like to do share buybacks. Moving on to the ROIC, one of my 7 golden dividend metrics. Watch that video if you have not seen it yet. I like to see it above 10%, and as we can see, Starbucks have been smashing it over the last 10 years. The only time where it was in that single-digit growth, single-digit, was essentially COVID, where we saw that sales decrease, and that's 9%. But the last year it was 29%, so very positive to see in my opinion, so that's a big tick. Operating margin around 60% is the preference for companies like Starbucks. As we can see, it's been around that 16% over the last 10 years, around 14% just in the last 12 months. So I would say that's positive. Free cash flow margin above 5% for companies like Starbucks, and as we can see, excluding 2020 where there was COVID, it has been above that 5%. So again, positive in my opinion in terms of looking at these metrics. Finally, just looking at the debt, the net debt to earnings before interest, tax, depreciation and amortization, we want to see below 3.5, and for the large part we can see that again. 2020, as mentioned, we could say is a bit of an anomaly as per COVID, so this is positive. And one thing that I'm really interested by looking at the graph on the right, the net debt to capital, I like to see below 0.4, but if you can see from 2019 onwards, Starbucks have essentially been financing their company from essentially equity rather than debt. Sorry about that. So it looks like Starbucks haven't been financing with any debt over the last 3-4 years. So that's positive. Now, one thing that we really want to find out, is Starbucks a company that is undervalued at the moment, and what is the intrinsic value? So if we jump straight into Graham's valuation, we can see that this works out by doing the earnings per share multiplied by 7, which is the PE of a company with no growth, plus 1 times the projected growth rate, times 4.4, the average yield of a AAA corporate bond, over the current yield of a AAA corporate bond. We input our earnings per share, the growth rate of 19 as per analyst forward-looking estimates, and we get to an intrinsic value for Graham's valuation at $75.41. Just to reiterate, Starbucks is trading at $108.19, so based on Graham's valuation, Starbucks looks to be overvalued. However, we don't look at any of these in isolation. We want to get the intrinsic value based on the 4 methods as an average. So in the multiples valuation, we are essentially looking at companies in a similar industry. We have McDonald's, Yum Brands, Domino's. We get the stock price earnings per share. It spits out the PE multiple, and we want the average of this. We then multiply it by our earnings per share to give the multiples valuation stock price of $83.97 for Starbucks, again showing signs of overvaluation. We jump onto the third model, the dividend discount model. We input the yearly dividends. We then do the current dividend multiplied by our growth rate divided by the cost of equity capital less the growth rate in perpetuity. So as you can see, the average growth rate has been quite nice over the last 5 years, 12%. I've gone for a bit more conservative, forward-looking 7% as the growth rate, and this gives our DDM price of $113.42. So final model, the discounted cash flow model. We want the free cash flows over the last 10 years. We get the growth. We then get our average growth rate, and we get to our growth rate that we've inputted. So I've put 19%, again in line with analyst estimates, lower than the average growth rate over the last 10 years, but again better to be on the more conservative side. We get our future free cash flows and the terminal value. Using the discount rate, we get the present value of the future free cash flows, and we have the sum here. We add the cash and cash equivalents less the total debt. We get to our equity value and divide by the shares outstanding. This gives a DCF price of $93.19. So we now have the 4 averages of these different stock valuation methods, and we get the intrinsic value based on these 4 at $91.50. Starbucks is currently trading at $108.20, so there's a difference of $16. Now, if you apply a 10% margin of safety, your acceptable buy price would be $82.35. So essentially we're saying that Starbucks is currently trading above its intrinsic value. Some people may argue that Starbucks is a company that trades at a premium. However, just to put in for investors who use a 20% margin of safety, the acceptable buy price is $73.20. Now, I just want to show you quickly, as you can see, the 52-week range, Starbucks has traded even below that at $68, so it's not something that necessarily could not happen. Obviously, it depends on the economic factors. Now, lastly, I'm going to jump into the Wall Street price forecast, and they believe the price will get to, in the next 12 months, $114.71. Now, hopefully you enjoyed that. Smash the like button, smash the subscribe button. Let me know your thoughts about Starbucks. Is it a company you're looking to buy, looking to sell? and let me know in the comments any companies that you want me to look. Thank you and have a lovely day.